What happens when interest rates change, and how do these changes ripple through the entire economy? It's a question that has puzzled many, as the effects seem far-reaching yet somewhat mysterious. Imagine you're a homeowner with a mortgage, a business owner looking to expand, or simply an individual with savings in the bank. All of these scenarios are impacted by interest rates. And here's the surprising part. Even small changes in interest rates can have significant effects on the overall economy. Think of interest rates like the throttle on a large engine, controlling the flow of money and credit to businesses and individuals. When the throttle is opened, more credit is available, and the economy can accelerate, but when it's closed, credit becomes scarce and the economy slows down. But how exactly does this mechanism work? And what are the real-world implications of changing interest rates? Let's break it down and understand the inner workings of this crucial aspect of the economy. By the end of this explanation, you'll have a clear understanding of how interest rates move the whole economy, and the mystery will start to unravel. To get the full picture, be sure to keep watching as we dive deeper into this topic. Vocabulary: interest, economy, throttle, credit. What exactly are interest rates, and how do they influence the economy? To grasp this, let's break it down to its simplest form. Interest rates are essentially the cost of borrowing money. Think of it like renting a car. You pay a fee to use someone else's vehicle for a period. Similarly, when you borrow money, you pay interest to use someone else's funds. And here's the part most people don't know. Central banks, like the Federal Reserve in the US, play a crucial role in setting these interest rates. They're like the thermostat in your home, adjusting the temperature to a comfortable level. In this case, the thermostat regulates the economy's temperature by controlling inflation and stimulating growth. When central banks lower interest rates, it's like turning down the thermostat. It makes borrowing cheaper, which can boost economic activity. On the other hand, raising interest rates is like turning up the thermostat. It makes borrowing more expensive, which can help slow down an overheating economy. Understanding this mechanism is key to seeing how interest rates can move the whole economy. Now that we've got a handle on what interest rates are, let's dive deeper into how they actually work. What happens when interest rates actually change? Does it just affect borrowing, or is there a wider impact on the economy? Let's break it down. Think of interest rates like the price of money. When it's low, money is cheap, and when it's high, money is expensive. Now, when interest rates rise, it doesn't just affect people taking out loans. It also impacts those with savings accounts, because they can now earn more interest on their deposits. And here's the surprising part. When interest rates change, it influences everything from savings accounts to mortgages and even the stock market. For instance, higher rates can make borrowing more expensive, which can slow down spending and investment because businesses and individuals might think twice before taking on new debt. Imagine a company that wants to expand its operations. If interest rates are high, the cost of borrowing money to fund that expansion becomes more expensive, so they might put their plans on hold. This ripple effect is what makes interest rates such a powerful tool for shaping the economy. By understanding how interest rates work, we can better see how they impact our daily lives and the broader economy. So, let's keep exploring this mechanism to see how it all fits together. Vocabulary: inflation, liquidity, recession, macroeconomics. What happens when interest rates rise? Do people and businesses just absorb the higher costs, or does it actually change their behavior? Let's break it down. Think of interest rates like the price of borrowing money. When you take out a loan or use a credit card, you're essentially borrowing money from a lender, and the interest rate is the fee you pay for that borrowed money. Now, when interest rates go up, the cost of borrowing increases, making loans and credit cards more expensive. For consumers, this means higher monthly payments on things like mortgages, car loans, and credit card debt. And here's the surprising part. It's not just about the direct costs. Higher interest rates can also make people more cautious about spending in general, because they know that borrowing money will be more expensive. This, in turn, can affect businesses, as lower consumer spending can lead to reduced sales and revenue. Businesses may then respond by reducing production, cutting back on investments, or even laying off employees, which can impact employment rates and ultimately the overall economic growth. So, the ripple effects of interest rate changes can be quite significant, influencing not just individual spending habits, but also the broader economy. Understanding how interest rates shape consumer and business spending is key to grasping the complex dynamics of the economy. If you're looking to learn more about how the economy works, be sure to subscribe for more explanatory content vocabulary. Inflation, recession, stimulus, liquidity. What happens when interest rates change in one country? And how does it affect the global economy, given that money can flow across borders almost instantly? Let's break it down. When a country's central bank raises interest rates, it's like putting a higher price tag on borrowing money within that country. And here's the part most people don't know. This doesn't just affect local businesses and consumers. It also sends a signal to foreign investors. They see the higher interest rates as an opportunity to earn more on their investments, so they start putting their money into that country's bonds and other financial instruments. As a result, the demand for the country's currency increases, causing its value to rise compared to other currencies. This is known as currency appreciation. Now, you might wonder, what's the big deal about a stronger currency? Well, it affects the country's exports. Imagine you're a manufacturer in the United States, and you're selling goods to Europe. If the US dollar appreciates, your products become more expensive for European buyers, making them less competitive in the global market. This can lead to a decrease in exports, which in turn affects the country's trade balance. So, changes in interest rates have a ripple effect, influencing not just domestic spending, but also the global flow of money, trade, and ultimately, the broader economic landscape. And here's the surprising part. This mechanism highlights how deeply interest rates are intertwined with global economic dynamics, showing that the impact of interest rate changes can be far-reaching and complex. Vocabulary: appreciation, competitiveness, exports, trade balance, landscape. So, to answer our initial question, interest rates move the whole economy by acting as a lever that central banks use to balance growth and inflation. This means when interest rates go up, like during times of economic overheating or high inflation, the cost of borrowing increases. People and businesses find it more expensive to take out loans for projects or purchases, which slows down spending and investment. And here's the surprising part. Interest rate hikes can even affect international trade. When a country's interest rates are higher, its currency tends to strengthen because people from other countries want their money to be in that stronger currency. This makes exports more expensive, but imports cheaper for businesses and consumers. On the flip side, when central banks lower interest rates, during economic slowdowns or recessions, the cost of borrowing decreases. This encourages spending and investment, helping to boost growth and employment. However, too low interest rates can lead to inflation because money becomes too cheap, making everyone spend more, pushing prices up. Understanding these mechanisms is crucial for grasping the economy's underlying mechanics. Whether you're a business owner, an investor, or just curious about how the world works, knowing how interest rates influence borrowing costs, spending, investment, and even international trade sets the stage for deeper insights into economic cycles. And if you'll never look at planes, the economy, the same way, you know what to do. Subscribe for regular explanations that peel back more layers of market mysteries. Let's break it down together in plain English and get smarter about the world around us.